All right, with this section, I just wanted to talk about a few things that I haven't spoken too much about yet. The income statement that you have been working with, that we've been talking about, is really called the multi-step income statement. Okay? And the multi-step income statement starts off with the revenue from sales, right? Here's your sales, minus any sales returns and allowances, minus any sales discounts, which we've discussed both of those at length, gives you an account called net sales. Net sales minus the cost of merchandise sold, or if you hear me say a lot of times, cost of goods sold, gives you gross profit. Minus any operating expenses. Now, operating expenses are usually separated into two categories: selling expenses and administrative expenses. Selling expenses are all of those directly related to the sale of the product. Okay, so a selling expense could be the salaries of your salespeople. It could be the depreciation on your store. It could be the property taxes you pay on your store. All right, all of those things that are store related or selling related specifically fall into the selling expenses category. Administrative expenses would be maybe Target probably has a headquarters somewhere. I don't really know where that is, but let's say Target has a headquarters somewhere. Well, they're not actually selling things out of that headquarters. They're just there to, manage operations of the businesses. So with that, they would be an administrative expense. Also, things like depreciation on the headquarters building, or depreciation on office equipment, not store equipment, but office equipment. All right, or maybe payroll expenses for the people who actually run the payroll. All those salaries for the people who run the business, not necessarily sell anything, but run the business, are going to fall into that administrative expense category. So you've got selling expenses and administrative expenses, and those together combine to be operating expenses. From there, you've got income from operations. And as I said before, you've got plus or minus any other income items. Typically, you see interest and things like that fall into there. All right? And this gives you net income at the end of the day. Now, let me just talk about how other income could be rent, let's say down here. Let me just talk about for a second why that would be. The reason why that would be is if your target, your main job, your whole reason, the whole way you make money basically is selling other people's products. So that is your job, that is your profession, that is what your business does, is it sells things. Okay? You are not in the business of earning revenue from, let's say, rent. All right. Let's say that I had a big open warehouse and I decided I was going to rent it out to, some small other store. Let's say, Walmart. Okay. Obviously, that was a joke there. It's not the smallest store, but the idea is that I am not in business as Target to make money from renting out space. Now, I could, if I had an empty warehouse, rent it out to some other company and make some extra money on the side, so this way my warehouse isn't just sitting empty and I'm actually earning something from it. Since that is not my core business, that is not what I do, it falls into that other category down at the bottom. All right? The only thing you want above that line, that revenue from sales line, is I want the numbers in there being based on what I do. Okay? That should be my core business, what's in the top part of this income statement. Any other way that I might make some extra money should fall into this other category. All right, and that's why this income from operations line is also important, because this is the line that tells me, did I make money or did I lose money doing my core business? Okay, running what my main business is. If this number is positive, great. If this number is negative, well, your main business is not making money. So that's also why this line is important and why it's separated from these other categories. Now, this is the multi-step income statement, and this is the one you see more often than not. There is also the option of doing a single-step income statement, which you've seen through the previous chapters. The single-step income statement is just all revenues, okay? So it would be your rent revenue, it would be your sales revenue, it would be interest revenue, any revenue that you had, gains on sales of products, or any of these sales of maybe business, machinery or a building. We'll get to that in a future chapter. All of those things get clustered into the revenue category, and every single expense is subtracted altogether. Okay, so it's all revenues minus all expenses. There's none of this categorization with gross profit. There's none of this breakout of other income or other expenses. It's simpler to prepare this revenues minus expenses single-step income statement, but it really, for all intents and purposes, is useless for the purpose of running your business and really seeing whether or not your business is earning any money. Okay, so you might want to do this revenues minus expenses to do like a quick and dirty income statement, but it's not going to give you the analytical tools a multi-step income statement would give you. Now let's be clear about one thing. The net income in either of these scenarios is going to be exactly the same because you're still subtracting all of the revenues minus all of the expenses. Well, you're still subtracting expenses from revenues here as well. It's just that you're putting them in categories that make sense in the multi-step income statement. So the end answer, the end result will be the same. They'll be identical numbers, but the difference is going to be how they're laid out and how you use the tool of the income statement. Okay, now there's one other thing. I was looking at the slides that I wanted to mention, and let me get there. Let me see if I can move this over. The last thing, okay, one more time. The last thing I want to talk about is FOB shipping point and FOB destination point. Now your book covers a lot about how you journalize these things, what the numbers are, how you calculate them. I'm really not worried about that so much. What I'm really more concerned about is you understanding the difference between FOB shipping point and FOB destination point. FOB stands for free on board. Okay? What it is it's really about when title transfers for the inventory that you're buying and selling. Let's just say that we are Target and we are having goods shipped to us from somewhere. Okay, so we're in New Jersey and we're our Target store and we're having something shipped to us from somebody who made, from some manufacturer. Okay, if the terms are FOB destination point, then it is entirely the people who we're buying from. It is entirely their responsibility to get the inventory to us, basically to get it to the destination point, the FOB destination. All right, so that means that if they're somewhere in the Midwest, they're responsible for the product all the way until it gets to its destination, which is me in New Jersey. All right, so let's just say it's a train, and the product that we're buying is on the train, and the train gets picked up by a tornado, and the product never makes it to us. Well, you know what? It's not my problem as Target in New Jersey. It is the seller's problem because their responsibility was to get it to the destination. They hold title to the product until it gets to its destination. All right? So it's really about when title transfers. So now let's flip it around. Let's say FOB shipping point. If the situation was that the terms were FOB shipping point, then the responsibility of the sellers of the product is simply to get it to the shipping point. So if it's going by train again, all they have to do is get it to the train, and from there, the inventory is mine all the way across the United States. Okay, so title would transfer as soon as the seller gets it to me at the shipping point. And that's really just the difference between the two. Now I'm saying, what if something happens to the inventory en route? But really, for purposes of year-end inventory, if there are products that are on their way to me at Target, I've already bought them, and the terms were FOB shipping points, then technically it's my inventory to include in my balance sheet. All right, so that's why it's important. If it was FOB destination point, and the product is en route to me, and it's December 31st, and it's not going to get to me till January 2nd, well, if the terms are FOB destination point, they have not made it to me yet, and they don't belong in my inventory. All right, so that's why it's important to have the shipping point and destination point clarified in any purchase and selling contracts. All right, so I think that about covers it for these chapters. I'm hoping there's nothing too difficult that I left out. You're obviously responsible for all the material in the chapter, and I hit most of the highlights, except for, as I said, I'm not really concerned about the journal entries behind FOB shipping or FOB destination. I'm more concerned with you understanding the concepts of it. All right, enjoy the homework.